Hey, welcome to the Exchange. Let's check out Allbirds. I absolutely love the shoes. However, the company as an investment is a different story. Let's take a look at it. So I pulled up here. This is their stock chart in the last, 4 or 5 months. They basically IPO'd in early November timeframe. And then really, I mean, you had a pretty strong IPO. It hit to $28 right there. See, $28.89 when it really IPO'd. It's been downhill ever since. They had a small spike in really mid-November timeframe. It was really the kind of peak market pre-Omicron, where those fears actually set in. And since then, I mean, it's just been a steady, either a flat or decline. I was curious yesterday. I was checking the stock prices for various companies, and I saw this one. I mean, I assumed it would be around $9-10 when given the recent headwinds we've had in the overall equity market, especially the growth side of the market. But I mean, it's sitting at $6, and I was like, hey, what is going on? I thought the company's better than this. Is it something going on internally that I'm not seeing potentially? So I decided to do a little medium dive into what's going on within Allbirds financially. So let's check out the financials first on this video. So when I pull up here, basically the model I built real fast. This is basically the past 3 years. Everything to the right of this line is basically future 5 years projections. Really, what we know right now is like guidance for 2022. And what they're saying right now, they're saying for 2022 guidance, $350 million to $355 million, or correction, $350 million was the original baseline. The raise to the $355 to $365. A small raise right there, which is good. They're also assuming they're going to open 16, 17 stores in 2022, which is good. I mean, they're really going for it on the physical brick and mortar infrastructure kind of sales tactic, which is surprising because I thought Allbirds is a lot more digital focused. Brick and mortar stores, maybe a couple showrooms around the country is kind of like potentially as basically marketing tools, but really they're going for almost like a Nike play or like a Lululemon play by having these small shops all over the nation, which is totally fine if it drives revenue. If it doesn't drive revenue, it's just a massive capex expense, massive working capital expense too. So that's really what they have there is kind of a fear going forward. So this is actually looking at the growth rates. And I mean, I would assume, hey, I would have thought before I checked the financials, hey, they're at 50%, 60% growth rate. I mean, you see their ads absolutely everywhere. I mean, they're a massive brand, I guess, for especially younger people overall. But we're seeing here, I mean, 2020, 13%, 2021, 26%. I mean, it's still growing. It's a fast growth rate, but it's not like, hyper growth. It's not like a software company where it's having that, 50, 60, 7% year over year growth. I mean, this really has slowed down. Now projections wise, they're assuming, and I think this is actually valid, is that 2022 have a strong kind of banner year for growth, just because like return to office post Omicron, it makes sense, honestly. But even then, it's not like a hyper growth. Where they're marketing almost now for hyper growth. What you see right here basically is overall decline as they basically grow and they get more saturation in the market overall. Profit margins are actually pretty healthy. They're not great. For a shoe company, you want to see it's around 60% almost. I mean, they're at 50, low 50s right now, which is not bad. I mean, I think it's going to shrink as they go forward just because of the competitive pressures, etc. I mean, if they can maintain 50% in the next 4 or 5 years, that's absolutely fantastic. I don't think they're going to quite be able to do that. They might have some discounting issues or pricing model issues potentially, but we'll take a look at that in the future videos too. Now, SG&A, I mean, this is a huge expense. They kind of roll up all of their kind of, both physical infrastructure, their sales staff, their, corporate staff, et cetera, and kind of SG&A. That's actually one big bucket right there. So looking at here, I mean, in the past years, I mean, it's been massively increasing. I mean, 30% in 2019 to 44% of total revenue, which basically, if you imagine that is, hey, every dollar you bring in cash, 44 cents goes out basically to SG&A expenses, which is, I mean, it's a huge number right there. I mean, it's not sustainable. Saying 2022, I mean, it's not going to go down that fast. I mean, absolutely has to go down because otherwise this company is not viable as a company. But I mean, this should drop off pretty fast. But I mean, the thing is, if it drops off too fast, though, that could kill the revenue base, which basically the company at that point could death spiral down. Really a big hot topic, and this is really the reason I think Wall Street kind of hates it a little bit, is really a marketing expense. They're basically trying to organically or inorganically buy growth through heavy marketing, basically. So the idea there is, hey, I mean, you have two different scenarios here. Either A, they have effective marketing, which is driving their top line revenue, but if their marketing is that effective, it's only getting 26.5% growth in 2021, which is not that great though, too. Or option B, which is even worse, is the marketing they have is ineffective. And what that point means is, hey, they're basically burning money, they're burning cash. The actual marketing itself is not well aligned to overall, overall consumer trends. Which, I mean, it is going to drop too. I mean, really pre-IPO, we saw this massive marketing push. So they were trying to increase their top line revenue as much as possible pre-IPO in their S1, just to have that, big IPO pop back in November, which they did. They honestly, it was a pretty good pop. But the thing is, the marketing spend, it cannot maintain current levels. I mean, it's just between the SG&A and marketing, basically OPEX spend in total, it's way too high for a viable company. And this is going to come down quite far. Operating income is actually not that bad. I mean, they're burning cash, but it's not like egregiously burning cash. The problem is here is, I mean, the growth rates, I mean, it's not quite there for like a massive, basically uptick, or that massive, almost like lift off you see in like, whether it's EV companies or software companies, et cetera. I mean, it's just not quite there. Interest expense is, I mean, almost none. I think they have $10 million of long-term debt. Their debt's, I mean, it's actually a pretty healthy balance sheet overall. Other expenses, it's pretty flat. It's basically forex, like foreign exchange, international trade, basically bringing on offshore, onshore, etc. You see 11.5 million here. This is pretty. Stands out. All it really is basically their IPO expenses of like the auditing, etc., the legal fees, investment banker fees, etc. That's all it's really showing. That's why this is a one-time expense, and this should go away. Obviously, tax expense is almost minimal because they're not profitable right now. So obviously, just like a consumer, if you basically make no money, your taxes are super, super low, if anything at all. Net income basis, I'm really saying right here, I mean, they're going to lose about $40 million this year. This is basically not a EBITDA or just EBITDA basis. This is on pure just net income basis. $40 million this year, $14 million next year. I know they're saying EBITDA, just EBITDA basis, next year they'll be profitable, but it's kind of a made up number right there. They have to use some basic accounting, Fugazi to help make that profitable. But I am saying by 2024, they have a chance of being profitable, assuming the revenue base doesn't drop off and assuming the actual OPEX numbers come down in 2024. They should be on a very good level overall. Through down here's also the EBITDA levels. For 2022, they were saying, hey, -13 to -9 is kind of their baseline for EBITDA. I mean, I think it's very possible, assuming there's no, like, I guess, obvious headwinds or recession or anything else happens, they should hit that number. EBITDA basis, they should be very profitable. Again, not heavy profitable in 2023, but by 2026, it should be a strong profit, assuming the overall revenue trends basically gradually increase, and assuming the OPEX comes down dramatically. Which, if it doesn't come down dramatically, then this is all made up. This doesn't even matter then, because that's their biggest issue by far. Look at the very bottom here. Basically, I pulled up some quick valuation multiples. This is it's a hard company to value because it's really one of those things where if it ramps up and really fast, well, let them keep saying it's going to happen, then obviously the value could be much higher. Or potentially, if they can't get the OPEX down, then this thing could be spiraling. I mean, they have cash right now. They have about $300 million in cash. So they have about 2 years run rate supply. So they shouldn't have to raise cash or issue bonds or have a new offering potentially anytime soon, unless they want to pad their balance sheet. But I think right now they really have a 2-year runway to actually implement changes or either reaccelerate growth or focus on a core niche market, which is another possibility too. So I pull up here for valuations wise is basically a FY26 EBITDA multiple. Put basically a 3-4-5 multiple, kind of show you the price points there. And this is based on the 2026 EBITDA multiple or EBITDA revenue, which is 144. So what you're seeing there, basically price per share, you're seeing is roughly $2 to $4. Really, 482 is kind of the high side, 289 is the low side. I think better for this company is actually the price to sales multiple, forward price to sales, and all that means is basically the stock price versus sales they have in revenue and what's the actual trading multiple at, or basically enterprise value over the sales price. Currently at 256, which is a little high for apparel, but again, they're still in a growth phase. They definitely are growing faster, like legacy brands like Lululemon or Nike, etc. Trading at 2, basically I looked at, hey, 480. Really, I think the baseline here, what they probably should be trading at is about 125. I think it's really the floor where, hey, anything $3 or below, I think this is definitely a buy, assuming there's no other issues basically internally with financials. But really, I see the floor as a $3, which are not that far off from it right now, at the $6 range. But I mean, again, that's another 50% drop. And that's one thing where, I mean, it's a headwinds, market, recession, anything else. I mean, it could drop far, way below that potentially too, assuming they can't get their cash flow under control. The good news right here is basically looking at the FY26 enterprise value versus EBIT average is 14 for apparel. So it's assuming FY26, what's going to happen there. So this is basically saying, hey, if potentially if everything goes according to plan with this, it's probably worth about 784 a share. Now it can be much higher, it could be much lower, depending on basically that ramp up, basically as revenue increases and as they scale up with their physical stores, which are pretty capex heavy overall. So the upside here is this is another comparison. This is On Running or basically on. It's basically a holding company of On Running, which is another apparel, shoe company, etc. Kind of like more niche category, more premium, high end. The price of sales forward is 8.19, which is extremely aggressive, extremely high. But I mean, they have a higher growth rate, a higher margin rate. So they're a better company in a way. But if Allbirds wanted to shift their brand around a little bit, they could get to that point if they potentially were to pivot a little bit. And if that's the case, I mean, Bird might be worth, the stock itself might be worth $19 right now, which is, I mean, that's absolutely fantastic. But that's kind of my thoughts right now. It's really one of those things where it's kind of in that gray area, but I mean, it should bounce potentially at $3 mark and basically bounce up, or if management changes and growth changes, and let's say physical stores come in, they take off, it absolutely ramps up, there's actually a huge marketing push, and it actually really drives the bottom line, actual net income, then it obviously be worth much, much more. But in the opposite case is, hey, OPEX goes out of control, they can't drop the OPEX spend down fast enough, and all of a sudden you have a cash burn, basically like, dinosaur right there, where they're basically spiraling the drain. So another big thing you hear about all the time for SPACs and IPOs is really the lockup period and what's going to happen with that. What's the timeline of that? So they're a little bit different at Allbirds. It's actually more common of a trend. So you have the normal 6-month lockup period. So that should expire May 2nd. So about a month and like a few days from there. Should be potentially another basically selling downwind, or maybe they're going to hold potentially too. But it's really the 180-day lockup only affects the directors and executive leaders. So really, it's the handful of people in the very, very top who have they have a lot of shares, but it's not many people overall. So one thing they did actually for their actually employee base overall is they actually let themselves at 25% of their shares within 7 trading days of their IPO launch date, which is, it's good for the actual average employee, but it's bad for retail investors because it's a brand new company, it's a hot company. It lets basically the insiders or basically common insiders dump their shares on the market right there, and then from there retail investors can buy them. So this third bullet is really important. So this is this says right here, following the opening trading on the second trading day after we publicly announced earnings for the quarter ending December 31st, 2021, which they've passed that point. The lockup period will terminate with respect to all holders of our common stock and securities exercisable for or convertible into our common stock. So basically what that means is if you're not a director or executive level leadership, basically after December 31st, earnings are announced, they could basically dump their entire stake right there. And basically what you have is like that one wave of selling coming in the last, few months right there from the basically November IPO to now. And now what you're seeing in May potentially is senior leaders or executive leaders actually potentially dump their stock starting May 2nd, which we'll see what that happens. It's at a pretty low price right now, so they might hold on to it too. But then again, they might hit like, hey, I need the cash right now. They might just burn the extra shares, which that could drive the stock pretty far down because it is pretty volatile. And then that's one of the things where it definitely could drop the overall price down. But we'll see what happens. We'll see if they dump their shares. You'll be able to tell by like early to mid May what's going on with that. And also look at the insider transactions too, be able to tell about that. So the really question now is how do they succeed? How do they actually grow? And there's really a couple options in front of them. Number one is really brand extension. So you start seeing like potentially new additions to the overall Allbirds line. So now they have a running shoe now they introduced. And the shoes are very comfortable and they're great shoes. You might see next is like kids shoes or like slippers or house shoes, etc. Something like that. Really ways to like, you have your certain consumers like me who really love Allbirds, and then from there, how do you grow their wallet share by adding additional brands or socks or maybe even apparel, maybe even like shorts and t-shirts or Allbirds, merchandise, etc. or like logo stuff. Maybe even NFTs or like who knows right there. That's one of the options we have. Now, obviously, revenue will go up. As you open up more stores, you're going to get foot traffic. It's just probabilities and time. You're going to get more sales overall by having all these retail stores all over the country, both U.S. and internationally. The problem is not now, but later on, let's say 2023, is same store comps. So basically what that means is revenue growth per store at the same location, which is, again, if it's growing year over year, even like 10-15%, that's fantastic. But if it's flat or declining on same store comp sales, that could be absolute, a death nail for overall Allbirds. So that's one thing. That's why I'm a little cautious about the, kind of these like for showrooms itself, like showing, hey, here's our product, here's what we do, here's how we make it. That's fantastic. But if it's true, like almost like a Foot Locker kind of store itself, that's where it gets capex heavy. And that's where I hate the actual comp sales may not be as good in the near future. Hey, but yeah, that's Allbirds. Definitely let me know your thoughts. This is an interesting company. I think right now they're priced almost at fair value, maybe a little bit above where they probably should be. Now, obviously, a post-Ukraine and post-COVID world, they definitely get a kind of return to office, kind of business casual bounce kind of in the summer months. But this is one of those things where, I would probably be a buyer, probably about $4.50 range. Maybe the floor being at $3, I'll start buying a little more heavily. Assuming there's no strategy or no financial kind of complications going on behind the scenes. But I think this company overall, they make a great product. But the problem is right now, almost like Shark Tank, you see sometimes you have a great product, but maybe not a great company. That's where they're at right now, almost riding that line of, hey, are they a great company right now? And that's the question really I don't quite know just yet. I really want to see next year or so how these physical store rollouts actually go, and potentially if they are successful. Best looking at same store comp sales potentially in 2023. But we'll see. Well, definitely let me know your thoughts. If you like the channel overall, subscribe, and if you like the video, hit the like button down below, and that's the exchange.